A decade after the financial crisis rocked the global economy, policymakers confront a risky world of what could be perpetually low growth, something Larry Summers warned about all the way back in 2013 in a speech to the IMF. And this week, former Fed Chair Janet Yellen agreed with Larry.
I agree with Larry's secular stagnation thesis that well before the financial crisis, structural factors had been boosting desired saving and depressing desired investment in most developed countries, causing real rates of interest to trend down.
We're back now with Larry Summers and Roger Ferguson. So, Larry, I guess congratulations, you were right, but I'm not sure you wanted to be right because it's not good news.
Secular stagnation isn't good news. It suggests much more profound trade-offs between rapid economic growth and financial stability and fiscal prudence than we thought we had, and raises all kinds of questions for macroeconomic policy going forward. But look, what's happened relative to the time when I put forth that secular stagnation hypothesis in 2013 is we've had bigger deficits than people thought. We've had lower interest rates than people expected. We've had more credit growth and higher asset prices than people expected. So the accelerator's been on the floor, but the car hasn't gone very fast. We've had lower growth and lower inflation than people expected. And what that suggests is that the underlying energy that the private sector generates is much less than it used to be, that we've been able to give some energy but only by having rising debt to GDP ratios, only by having quite extraordinary monetary policies and low interest rates. And there's a question how long that lasts, and there's also a question of what the long-run side effects of that are. You know, people say that the so-called neutral interest rate has declined by 2 or 3 percentage points. What I've been able to show in some recent research is that if we hadn't been running up the national debt globally, that probably that real neutral interest rate would have declined by 4 or 5 or 6 or 7 even percentage points. So there's a fundamental structural challenge around the fact that people are living longer, more of the money is going to people who have high savings rates. And at the same time, as you see with my cell phone that costs $500 and has 100 times as much computing power as the whole Apollo project, capital goods are getting cheaper and cheaper. And so the money sloshes into existing assets, leading to asset price inflation, but with limited economic energy. It's a little bit like the plight of Japan, or you might even call it a monetary black hole.
So, Roger, as an investor, how do you process all that? Basically, I think Larry's saying we've kept it growing, but basically running up the credit card.
No, look, I think Larry's points are certainly well taken in terms of what happened in the last decade. The way you process it is to say 2 things. One is there going to be a fundamental change anytime soon? In particular, you know, what we haven't talked very much about is one of the things that's kept rates so low is inflation. And so inflation, for a variety of reasons, has been a no-show, which has allowed central banks to continue to be, you know, very, very accommodative and to drive down interest rates. So the way you play it is, first, is that picture going to change? Are interest rates going to start picking up anytime soon they have to worry about? Secondly, as I said before, you know, what are the asset classes that are going to benefit or not benefit? And so you're going to have to be thinking, you know, much more cleverly about, you know, how you differentiate. You also are looking for, this has been a global phenomenon. Is the U.S. still the best place to be, or should we be looking at different emerging markets? How should we think about it? So again, I think this is a time where you move from the broad general down to a much more narrow, much more focused, much more particular theory.
Roger, it strikes me that you are an investor, but you also were vice chair of the Fed. Right. Have the central banks basically done what they could do? Essentially. I mean, they've really kept a lot of stimulus, monetary stimulus, and have they basically done everything they can do?
So, look, I think the general consensus, and I share it, is that the last recovery depended much too heavily on central banks. Even here in the U.S., where we had some fiscal stimulus, in hindsight, a lot of folks think maybe we should have done more and kept it going. Certainly, if one looks in Europe, clearly we'd say central banks were asked to do too much. So yeah, I think too much weight has been put on the shoulders of central banks. They responded by doing a couple of things. One is using their regular tools, i.e. called interest rates, and then two, using some unusual tools, some new tools, quantitative easing for sure, building up the size of their balance sheets, going in and buying a variety of fixed income securities. And then they polished up the use of forward guidance. What was it they said? So when you look at the debate that's going on, the question is that enough, and will that be sufficient the next time around? And I think that's really a question that we former and current central bankers are worried about.
Larry, this is something that was the topic of discussion at the AAA, that conference that you attended in San Diego. One of the things that you raised, I believe, others have raised as well, is something called semi-automatic stabilizers. Basically, as I understand it, automatic fiscal injection when certain things turn south. Is that a realistic alternative?
It better be. Ben Bernanke gave a speech out there, which I think was a kind of last hurrah for the central bankers. He argued that monetary policy will be able to do it the next time. I think that's pretty unlikely, given that in recessions we usually cut interest rates by 5 percentage points, and interest rates today are below 2%. And I just don't believe that quantitative easing and that stuff is worth anything like another 3 percentage points. So I think we're going to have to rely on putting money in people's pockets, on direct government spending. I think that's okay in a country where public investment and infrastructure are decaying so badly. But I think that's where we're going to have to look for our countercyclical energy. And what Olivier Blanchard and I were talking about when we discussed semi-automatic stabilizers was the idea that rather than relying on Congress to organize itself to act each time there's an economic downturn, we should do more with rules that would lock in changes in spending, perhaps greater assistance to states, perhaps more assistance for people who are unemployed, perhaps working off a backlog of infrastructure investments, perhaps giving temporary tax credits for those who spend, and that kind of fiscal stimulus is going to have to be a larger part of the story. And I think central bankers have a very difficult road to walk, because on the one hand, they don't want to say they're out of gas and they can't solve the problem. Right. On the other hand, they better be giving some warning if they want fiscal policy to be ready next time. And I think that's reality, that it's going to need to be.
But Roger, is it the fact and amount of fiscal stimulus, or is it what it's put toward? Because President Trump had a huge fiscal stimulus, right. $1.5 trillion, something like that, in tax cuts, and that doesn't seem to fix the problem.
No, I agree. So first, to start with your first question, Larry, are semi-automatic stabilizers realistic? My theory, and I think Larry wouldn't disagree, is they're probably not realistic. I mean, it's going to be very hard to get any legislature to get our Congress to say, we're now going to take our hands off the fiscal tools and let it work in some automatic fashion. That's not the way politics work. Secondly, I agree with you that how the fiscal stimulus is used is really important. Case example is Japan. Huge amount of fiscal stimulus, yet they still have been, well into their second decade of very, very slow growth and borderline disinflation or deflation. Third point I'd make is we have to be careful about making this an either or. This is going to be a both and. Whenever there's another recession, monetary policy is going to have to continue to be aggressive, I hope stopping before negative rates, which we saw in Europe. And we will have to have learned the lesson from the last time around, which is fiscal policy is going to have to come in more quickly, more aggressively, and Larry knows very well. The last time we confronted this in the U.S., I think we're a little bit more hamstrung in fiscal policy than we wanted to be. And so we're going to have a better sense of, without being overly dramatic, we're going to have to let it rip, so to speak, on fiscal policy, because indeed monetary policy will do what it can, but Larry's right, there's a limit to how much further it can go. So I think we ought to be careful with the debate.